In this video, we're going to walk through an example for accounting for debt securities that have been classified as hold to maturity. Again, that requires both the ability and intent to hold the debt until maturity. We're told that the Shamrock Corporation purchased $72,000 of 9% 5-year bonds of the Chester Corporations. The bonds provide an 11% return, and Shamrock classifies the investments as hold to maturity and uses the effective interest method to amortize premiums and discounts. First thing we're asked to do is pick up the face value, which is the $72,000 given in the problem. Next, we have to calculate the original purchase price or carrying value. We do this with our financial calculator or Excel formulas in this case. 5-year term, the market interest rate is 11%. Again, that's what investors are expecting to earn. The stated interest rate is 9%, and we multiply that by the $72,000 par value to get the coupon payment. And then we enter the $72,000 as the par value and solve for the present value of that bond. Next, we start building at our amortization table. The coupon payment is $6,480 a year, and that again is the 9% stated rate times the $72,000 par value. The interest revenue we expect to earn in the first year will be the 11% interest rate, the market value, times the $66,678 carrying value. Of course, our interest revenue doesn't equal the cash received, and we're going to have an amortized discount in this case. And that's the difference, again, between our interest revenue and the cash we received. And of course, that will increase the carrying value of our bond. So we take the prior value of $66,678 and add to it the $855 amortized discount. And if we've entered our formula properly, we can just copy that down our amortization table every year for all 5 years. We're asked to prepare our journal entry to record the purchase. And again, we have recorded debt investment. We don't have a premium or discount account that we use for debt investments, unlike for bonds payable or notes payable. On the liability side of the balance sheet, we use or show premiums and discounts. On the asset side, we don't. And typically that's mostly related to the fact that these often end up being carried at fair market value. So debt investment, $66,678, and of course we credited cash for the same thing. As we know, every row on our amortization table gives us the information for our journal entries for year 1, journal entry for year 2, journal entry for year 3, and so on. So we're asked to record the journal entry for receipt of the first coupon payment. That's the cash received. We'll record interest revenue, and again, the difference will be the amortized discount. So we're going to receive $6,480 in cash. And again, link these to your amortization table. Our interest revenue was $7,335, and again, that is the 11% market rate multiplied by the carrying value. So the 7,335 is 11,000 times 66678. The 7,429 is the 11% times the 67,532, and so on. And then finally, we pick up the amortized discount, and that increases over time the value, carrying value of our debt investment until the very end of 5 years. It will equal its face value or par value.